Hey guys, welcome back to the channel. I hope everyone is doing great. So today, Panda wants to take on the Defiance ETF's Total Return Trust Me Bros. So sometimes I like to watch other people's videos, and sometimes in the comments section, I see things about total return and how QQQY, JEPY, IWMY, they're not gonna perform as well. There might be some truth to that, but remember, this is part of the strategy. You're selling cash secured puts, so you're gonna have a truncated upside, and then you'll have allegedly infinite downside. But in real life, that's not gonna happen unless there's like some type of disaster scenario. So this is kind of like the new type of FUD. So once again, I have to step in and defend the honor. And just to note, I do own shares of Triple QY and JEPY as part of my portfolio. So for better or for worse, I like to eat my own cooking. So I think the first thing people need to take into account is the context. I'm not hating on the people, I'm just hating on their ill-informed opinions. I'm thinking that most of these haters are probably on the younger side, and I think they like to throw around like new buzzwords. I mean, it's new to them, but these type of terms have been around for a while. For example, now the new buzzword is total return. So you got a lot of keyboard ticklers out there trying to spread FUD and misinformation. However, I will give some like a break to some of these people. So for example, if you're a young guy or girl and you have a high healing factor, meaning you have a high tolerance to unrealized losses, and you're saving for the long term, about 40-ish years, and you plan to add to your position on a regular basis, for example, dollar cost averaging or maybe buying near the lows, etc. And you're trying to go for the highest return, which makes sense. For example, you could just buy SPY, Triple Q, or IWM, the regular ones, the regular ETFs, and if you hold that long, chances are you're going to ride out most of the storm, and you're probably going to have I hope that you have a higher return. But I'm going to knock some of the people because you're not thinking about other people. What about your granny? What about your grandpa? Maybe you have like older like uncles and aunts, and they're gonna need cash for living. These people, they can't eat capital appreciation, and they can't eat hypothetical returns. And also one consideration is, for example, if you're on the older side and the more mature side, probably you've already quit your job, or maybe you've moved on to like a part-time job. So chances are you probably have a lower tax rate, so the effect about of these triple QY, JEPY, IWMY, etc. Even though you have a higher ordinary tax rate, chances are you're gonna be at a lower overall tax rate just because you don't have your normal job anymore. But I'm not a tax advisor, so everybody has to kind of look at their own personal situation. And I would appreciate if you can help guys like spread the word. If you can like and subscribe. So I want to nip like some of these unwarranted FUD in the bud, so to speak. So again, like some of the common objections, like first, people are spreading the NAV erosion fears, but you have to. I mean, you tell me, what investment has not had some down days, right? Then you have the new FUD. You have to look at the total return. Look, I get it. Like some of these, like the SPY, IWM, Triple Q, etc. In theory, they should have a higher total return. But and then like all these trust me bros, that's all you need. Well, not quite. You have to look at the person's personal risk reward tolerance and also like their own like living situation. And of course, I guess like the other risk would be like a manager risk. That's very true. Uh, in the future, maybe if they move on from like Zago Financial, for example, Defiance and YieldMax, like for whatever reason, maybe they're too expensive or whatever, that would be a like a big red flag to me. But so far so good. So I'm gonna keep my funds. And of course, like some of the other common objections are the return of capital. So it's just a partial refund of your original investment, which I'd rather have rather than like just losing it completely in the market. So at least they're giving you something back. And allegedly, this will also have like a slightly positive tax effect. Again, I'm not a tax advisor, but you can do your own research on your own time on that. What I think matters for most people is your actual yield on your actual cost, and that's why I always preach having some cash on the sidelines so you can average it in, so you can get your overall cost basis down. And then, oh, sorry, uh, I know some of you hate the ums, but hey, I'm only human. Well, I'm only a panda. So you want to keep for some people that are worried about having uh, like say like you have already like a good paying job so I know like some of you are tech bros and finance bros, so chances are you probably have a higher income. So what you could do, you could probably keep these funds in a retirement account. If just you don't need these funds to pay your bills. So and then also I want to address like the actual proof. Some people say that they have like these crazy high like total return figures, but I haven't seen like actual like even an analysis or any type of like proof. Uh, of course, like I don't expect people to show their everything about their brokerage accounts or the tax returns, but maybe just like hide out like your like the sensitive information. I'm still looking for like an actual YouTube video analysis because most people are just showing like either seeking alpha or like some type of hypothetical index. So if you guys like have any information about that too, feel free to link it in the information below. Chances are I probably already read it, like on especially if it's on like seeking alpha, like anything like that's public. So any help would be greatly appreciated. I would like to conduct my own analysis on this, but there's not enough information right now. And I think some of the real risks are still that triple QY and friends. They're still not battle tested during brutal drawdowns, and it's definitely not immune to any disasters. In fact, I actually made a recent video about what could potentially happen in a disaster scenario, so you can check that out on your own time again. And there is a shady ETFs closed-end fund tactic. So some people like to do reverse stock splits to make the price look better. And then of course, you also have to watch out for liquidity risk. Like for example, for myself, I'm always checking like the volume because just in case in the future, for whatever reason, there's like uh, some type of crazy incident. Like I want to make sure I have enough. There's enough volume for me to get rid of my positions if it ever comes to that. Just in closing, I think everybody just needs to take a look at their own personal risk reward trade offs. If you want high yield, you have to expect higher volatility risk. If you have less time to go, and for example, if you're heading into retirement or you're already in retirement, you're going to need more cash. You could smooth out some of the volatility with sufficient diversification. And of course, if you're like a hand ringer, you're scared. There's nothing wrong with hiding out in something like a little bit more conservative, such as CS, HD, money markets, gold in your backyard, etc. So if you like this type of content, please consider giving this a like. If you could subscribe, that would be greatly appreciated as well. I appreciate all my new subscribers out there. Eventually, my goal is to maybe just like make $1 off of YouTube, or maybe help a panda get a sandwich. That'd be greatly appreciated. So thank you for watching. I hope you have a great one. Please make some good money out there. Bye now.